Hi and Assalamualaikum. We are from Group 7. We'll present for the case of Greenfield about the impairment for Goodwill. So, these are our team members. Let me introduce some details about Greenfields company. Greenfield Company is a French company producing processed vegetables that were founded in 1970 by Louis Chandon. Greenfield Company started their company with canned mushroom, followed by washing, cutting, and packing vegetables. Greenfield produced and traded of a wide and diverse range of preserved fruit, vegetables, and mushrooms. The company produced ready-made products such as soups, sauce, and pasta dishes. Greenfield also provides to 100 countries based on 3 technologies: canned, frozen, and fresh ready-to-use food. Before I continue with the issues arise, I will share some of the chronologies of the Greenfields case. Within the year of 2000 to 2010, the company emphasized on internationalization by strengthening its presence in Europe and North America, then continued to expand through acquisition in emerging countries such as Russia, Hungary, and Ukraine. Greenfield enjoyed a sustained growth evenly divided between internal growth and external acquisition, and the group experienced strong growth again in 2018 with revenue up to 8%, mainly outside of Europe after marked increase of profitability in 2017. The management consultant realized some challenges of explaining a complex accounting model to non-specialists in Greenfield Company, as the accounting treatment of Goodwill has been much source of much debate and controversy among the accountants. Okay, next, I will share with you what are the issues arise in Greenfield's case. The first one is, by looking through this case, what factors does Greenfields are looking in order to determine the cost of capital? The second issue is, what are the impact of taking into account certain factors related to country risk for determining the discount rate in an international framework? Lastly, as stated in the case, Mr. Crowden stated that he will read about the value of goodwill of recent acquisitions and reports in the group consolidated balance sheet at the end of the year. He did not understand why the company tests the impairment of goodwill, because he thinks the value of goodwill can be considered as a negative signal to the family and other investors. So, should they test for the goodwill impairment? That's all for the 3 issues. I will pass to the next presenter for the ethical dilemma.
As the issues arise, we have observed that there are 3 ethical dilemmas. First is whether weighted average cost of capital WACC is suitable to be used or not. WACC affects the compliance with IAS 36 impairment of assets. It is a primary method to a firm's business organization, which frequently comprises one financing source, as the firm may adopt both liability and equity financing. According to the Greenfields case, WACC is one of the standard models that they used in practice. Secondly, whether the implementation of WACC to estimate the discount rate is affected by the country's risk or not. IAS 36 compels the use of a pre-tax discount rate for the discounting cash flows. When evaluating a business, the most broadly practiced method for figuring out a discount rate is WACC. A risk adjustment may occur for acquisition in emerging countries by adding a spread called the country risk premium to the WACC determined for Europe. There are two ways of incorporating country risk. First is adjusting the cash flows, or the second one is changing the discount rate related to the cost of equity and debt. Every year, Greenfield estimates the WACC, which is also the discount rate for Goodwill impairment testing of the acquisitions in Europe and elsewhere. Lastly, whether the Greenfields should impair the Goodwill or not. As Greenfields company continues to expand through acquisition in emerging markets, it does comply with IFRS 3 business combinations. Applying IAS 36 impairment of assets, Greenfields is required to test its cash-generating units containing goodwill for impairment at least annually, even if there is no indication that CGU may be impaired. Based on the case, Greenfield has used this model to evaluate the investment projects or test the acquisitions for goodwill impairment in the local market and away since 2018. Greenfields also stated that WACC reflects the company's overall financing costs and the expected minimum rate of return for capital providers.
Now I will present the position part, which are pros and cons. Since the estimated future cash flow for the determinations of value in use are specific to the entity, the discount rate is not. Greenfield used weighted average cost capital (WACC) to evaluate the impairment test for goodwill in France and abroad, even in the emerging country. The pros of implementing WACC for impairment goodwill are: first, under IAS 36 require that use of pre-tax rate that reflect current market assessment of the time value of money and the risk specific to the assets or CGU. Although estimated future cash flow for the determinations of the value in use are specific to the entity, the discount rate is not. Instead, the discount rates reflect the returns that market participants would expect from the assets or the CGU based on its specific risk and on time value of money. One of the more common models that is used in the practice is the weighted average cost capital. The second pros is the WACC expected minimum rate of return for the provider of capital. The WACC help company to increase their value because the lower the WACC, the higher will the value of the firm. The WACC calculates the expected returns to all the stakeholders who have provided funds to the company. The annual cost expressed as the percentage represents the minimum returns to be generated by the company to meet its investor expectations. The last pro is it represents a large part of company value. A large amount of goodwill impairments could mean that a company is not making sound investment decisions in physical assets, or that it could be paying more for an asset than it should. Goodwill can represent a large part of company value or net worth. If a company doesn't test for a goodwill impairment, it could be overstated its value or net worth. Since goodwill is an intangible asset, treating it like a normal asset and amortizing it does not give a clear picture as to the value of the assets. It needs to be tested for impairments once a year. In determining the appropriate cost of capital is often seen as a dark art at the best of time, but in emerging countries where the uncertain economic conditions, the difficulty has been compounded. The first disadvantage of WACC is, first, the risk adjustment may take place by adding the spread called the country risk premium to the WACC. In fact, the additional risk of investing in an emerging markets can be diversified away. Then there should be no additional risk premium charge. However, the increasing correlation across markets suggests that country risk cannot be entirely diversified away. Then it makes sense to think about estimating a country risk premium. In incorporating a country risk premium in the discount rate is flow because not all projects and or company are equally exposed to country risk in every country. Second disadvantage is WACC calculating in emerging countries are complex and time-consuming exercise. Estimating an appropriate cost of capital for discount rate in developed countries where a relative abundance of market data and comparable company exists require a high degree of expertise. Besides, it can present a greater challenge, primarily due to lack of data and the potentials for magnified financial, economic, and political risks. Although the theoretical fundamentals of the WACC models are widely accepted, but its weaknesses in practical applications are also generally recognized, especially in the emerging economies. Difference in risk and a lack of understanding how emerging stock market returns are influenced by developed markets, as well as the lack of the reliable long-term historical market data. Finally, emerging market data can be challenging to work. The last disadvantage of WACC models is there is much confusion and disagreement about how country risk should enter computations. There are issues on how the assets of company exposed to country risk. Some research suggests using the discount rate adjustment to account for country risk, but whether the risk of an emerging market is reversible or non-reversible risk. If the additional risk of investigating can be reversible away, then there should be no additional risk premium charge. However, an increasing correlation across markets should suggest that country risk cannot be entirely reversible away.
Next, I will present alternative position for Greenfield is adjust cash flow using the present value of free cash flow. This is simple analysis can be used in investment choice. For example, Greenfield investor calculate the present value of operating free cash flow in order to assess the value of a business. We must identify the cash flow before discounting them to the present value. Firstly, operating cash flow calculate by taking earning before interest and tax and adjusting for the tax rate. This is operating free cash flow involve both debt and equity supplier. Valuation method is based on the operating cash flow that are produced after deducting capital expense, which are the costs of maintaining the asset base. In order to value the overall business, this cash flow is taken before interest payment to debt holder. Lastly, our group choose WACC because increase in WACC signifies a decrease in value, increase in risk. A firm WACC rise as its beta and rate of return on equity rise. Alternative positions for the issue is cost of equity will change if capital structure change, while WACC remains stable regardless of the capital structure.
Assalamualaikum and hello everyone, I'm Hamizah Lamila and my magic number is S50417. Now I would like to do summarization regarding to our findings about this case study. Before that, to determine whether the asset should be impaired or not, we have to evaluate there are indicators for impairment. The indicators can be categorized by two, which internal and external indicators. Examples of internal indicators are evidence of obsolescence or physical damage, changes in the extent to which an asset is used or is expected to be used, such as an asset becoming idle. Meanwhile, examples of external indicators of impairment are changes with an adverse effect on the technological, market, economic or legal environment in which the entity operates, such as increase in levies. Apart from that, there are also some challenges in accounting for goodwill impairments like judgment and assumption, also risk and uncertainty. Now, regarding to the case study, the world is more connected than ever before. With advancement in science and technology, economies from all corners of the globe have become interdependent. This interdependence means that firms that do business in emerging and frontier economies are accessible to both consumer and investors from developed nations. With the ever-increasing growth of emerging economies such as Brazil, Russia, India, and China, known as the BRIC nations, investors are looking for the ways to diversify their portfolios to include security from these markets. When companies undertake investment in emerging countries, they must forecast their future cash flows and discount them at an appropriate discount rate. There is much confusion and disagreement about how country risks should enter these computations. including a country risk premium to the firm's weighted average cost of capital, which WACC improves the discount cash flows or DCF. This ensures that appropriate discount rate is applied when using nominal figures to discount the firm's future cash flows. A country risk premium should be selected that fits with the overall picture of the firm and the economy. There is a hard and fast rule when choosing a country risk premium. However, quite often individuals like amateurs and professionals will overestimate the premium. A method is to look at the premium in the context of the capital asset pricing model, which CAPM, making sure that the historical returns of a company's stock are taken into account. Finally, WACC is used to calculate the discount rate. This is the formula of WACC, where E is the market value of equity, D is the market value of debt, T is the corporate tax rate, CD is the minimum interest rate which the company could raise new funds of the debt market, and lastly, CE is the minimum required rate of return expected by the company's shareholders. That's all from us. Thank you for lending your ears. Till the next time, take care everyone and bye bye.